How's everybody doing on this wonderful Friday night? Welcome back to the Strategy Room. Welcome back to another week. Hopefully, another great Friday night here with the banker next door. I am your host, Dr. Joe Berquist, and tonight I've got a great round of another ton of banking information this week. A lot of crazy things happening. We had the employment numbers that came out this morning. We had crazy port strikes going on all week. All kinds of crazy nonsense going on. So. All right, so I figured I would kick us off tonight. There was a couple of articles I wanted to go through here, and then I will get to some economic indicators. I will get to some other banking news that's going on here, but let me bring this up first. There was a couple of key articles that I saw this week that I just wanted to get into. So the first thing I wanted to jump into here was this is the NAR lawsuit, the National Association of Realtors. So this basically is an article that basically says the NAR lawsuit rocked the industry, and it's now taking its toll on the agents. So for anybody who's not familiar, this is a big deal. There was basically some big lawsuits that were filed against the Association of Realtors. There was a number of big agencies, think like Keller Williams, Coldwell Banker, places like that, big names in the industry. They basically settled on this lawsuit, but one of the big things that is coming out of this is basically, hang on one second here, let me just find my notes. One of the big things that is basically coming out of this now is ultimately the effect on the agents. And what's really at the heart of this is the fact that, so how do I want to say this? So when you have a seller, you have the buyer's agent and the seller's agent. And on the seller side, you have, usually the seller is paying the fee for the agent. So, typically it's pretty typical to have like a 6% real estate fee. And a lot of time, and that can get negotiated. So it's not always 6%. I mean, it could be 5% or it could be 4.5%. I mean, it just depends on kind of the deal and, what gets negotiated there. But generally speaking, what happens in the real estate transaction is, you buy a house and the buyer's agent, like if you're the buyer, your buyer's agent that's representing you actually is going to get paid by the seller's agent. So in other words, when that money comes in, the seller of the real estate is going to pay that 6%. And that's going to then go to the seller's agent, who's then going to divvy that up as 3% and 3%. Usually, again, this is all negotiated, but that's just for argument's sake, we'll just say 3% and 3%. So then the seller's agent is going to send that 3% over to the buyer's agent, and that's how the buyer's agent gets paid. So what's at the heart of this lawsuit is basically they're saying like, no. We're not going to do that anymore. And effectively, what should be happening is the buyer should basically be paying for their agent, and the seller should just be paying for their agent. And that's caused a whole lot of upheaval here. So I just wanted to share some of the comments in here. So if I just read a couple things here. So if there is a primary consequence real estate agents expect from the National Association of Realtors Commission's lawsuit settlement announced earlier this year, it's that it will pressure agents to quit their jobs. A new survey by real estate firm Clever Real Estate found that 86% of agents surveyed believe the settlement will lead to agents leaving the industry. Additionally, 48% of the agents surveyed said that they were more pessimistic about their careers since the settlement announcement, and just 16% feel more optimistic. One of the trade groups here is the trade group also agreed to a series of internal changes it put into place in August, including sellers no longer being able to make offers of buyer broker commissions on any multiple listing service the NAR owns. So it is very typical for residential realtors to be part of what's called an MLS, a multiple listing service. That multiple listing service is where all the realtors, that's where they put all the data. It's where they put all the listings. Everything goes in there and then kind of feeds out of the multiple listing service. So you think of like realtor.com, all that information comes from a lot of the MLSs around the country, basically. And so again, this is just talking about one of the trade groups basically said, so in other words, what would typically happen is, seller's agent goes into the MLS, they list a house for sale, and then they put the information in there on the broker's end and basically say, okay, the buyer, I'm offering to the buyer broker a 3% commission if you bring me a buyer on this house, So then the buyer broker, when they're on there, they're looking at it and they're going, oh, this is great. Okay, this person. So typically, if for some reason it was not listed that the selling agent would offer the buyer agent a 3% commission or a 3% chunk of that fee, the buyer's broker would basically move on to the next house. They'd basically say, okay, I'm not showing that house to my client. I'll go to the next, 15 on the list that are all offering that commission. So now what this lawsuit is basically saying is that they can't do that anymore. They can't put that into the MLS. They can't make that a part of the listing when they initially put it out there on the MLS service. So furthermore here, the Clever survey shows that 64% of agents oppose the changes to commission structure and 76% believe the changes will hurt first-time home buyers. 2/3 of the agents surveyed believe buyers will now be more hesitant to use an agent. And then among other findings here, 83% of agents plan to experiment with new business strategies. 35% of agents say they'll avoid working with sellers who do not provide concessions to help buyers cover agent fees. And 67% of homeowners support the changes, although only 26% admit to having a strong understanding of the lawsuit. So I think one of the things here, if I could venture a guess here, when it says like 83% of agents plan to experiment with new business strategies, I would venture to say that that's going to be some kind of form of, all right, you're a buyer, you're a home buyer, maybe a first-time home buyer, or maybe you're upgrading, whatever. But you're a home buyer, you're going to buy, and now you come in and you basically say, okay, I want to contract with you, Mr. Agent, and there's going to be some kind of fee that you're going to have to pay up front. Whether it's $500, $1,000, something like that, but you're going to basically pay that agent up front for that agent signing a contract with you and then taking you around to show you a bunch of houses. That way, at least if you don't buy anything, they're still getting paid something for their time. I mean, again, I don't know that is or isn't the case. I'm just kind of taking a venturing a guess here as to what that could possibly mean when it talks about experimenting with new business strategies. So, and then the article goes on to say that a separate survey of real estate agents, and I'll kind of roll down here a little bit. So here you can see some of the numbers there. So a separate survey of real estate agents by the Real Estate Brokerage Inc. found that most home sellers are still willing to offer a buyer broker commission even after the settlement. So 63% of agents said sellers are still frequently covering buyer broker commissions, with 21% saying sellers were occasionally covering the commissions. Additionally, 55% said sellers were offering buy-side commissions of 2.5% or greater, while 30% said sellers were offering commissions below 2.5%, and only 1% said they noticed a shift towards so-called flat fee models. In the last 4 weeks of July, the typical American home seller paid a 2.55% commission to the real estate agent hired by the buyer. According to MLS data analyzed by real estate brokerage Redfin Corp, that's down from 2.62% in January. So the average commission paid to his buyer's agent in the U.S. is $15,377, up slightly from $15,124 in January. So, that's a good. I think that's a pretty good fee to the buyer's agent. I mean, it's not bad. The decline in commission rates being seen this year has actually been occurring slowly over many years, dropping from 2.89% mark in 2013. So basically, over the last 10 years, we've seen kind of a declining trend in the percentage of money that's being paid out. So and then the article just concludes by saying, there's not going to be a massive change tomorrow, but this could be the start of unbundling of services, and that might bring more transparency around fees and pricing, along with greater competition for services. But it's too soon to tell whether that ultimately brings down commissions or pushes people not to use agents. The pressure on commissions also comes from the fact that it has been a seller's market, a very important point. And many sellers felt that they didn't need to offer buyer commissions to sell their houses, which I think in a lot of cases is probably true. But that might change in a buyer's market. Like, in other words, there are times in real estate when it's a buyer's market, and there are times when it's a seller's market. It's been a seller's market for quite a while now. And but at some point that pendulum will shift to the other end, which will be a buyer's market, and then people might feel differently about this whole thing. But I just wanted to point it out because I thought this was a very kind of important update on what was going on here. I've been monitoring kind of the whole NAR lawsuit, and I did an episode on this a few months back, and I've just been kind of waiting for things to update or things to change as things were kind of moving along. And so that's the update on that. And like I said, we'll continue to keep an eye on it and see how things play out. There are certain things that I know have to be implemented here within the next couple weeks. So, we'll see what happens there. Okay. Big news on the SBA front this week. I know I just did a couple of SBA episodes. I did a friend of mine, Paul Avery, who's an SBA lender. I did an interview with him, and then I did an SBA update. But now we've got this article here. So basically the SBA eases debt refinancing with big loan program changes. So this is basically relates to the 504 loan. So the Small Business Administration has issued a final rule making it easier for small businesses to refinance some of their debt. So the new rule, which becomes effective on November 14th, revolves around the agency's 504 loan program, simplifying some rules and waiving old restrictions in order to make the loans more flexible and widen the businesses that qualify. So one goal is expanding access to small businesses. So the 504 program offers loans through a community development corporation to purchase or construct buildings or new facilities, buy land or purchase heavy, long-term machinery and equipment, along with other uses. The SBA guarantees the resulting loans from the 504 loan program, which allows larger financial institutions to package them and sell them as an investment vehicle. So, and then it gets into some of the changes that occurred here. I'm not going to go through every single one of these. I just wanted to point out that this was something that the SBA announced. I think it's a good thing. 504 loans are, I would say they're more traditionally used with real estate purchases now, but now with refinancing. You can use them for machinery and equipment loans, but, sometimes that gets a little stickier or really. I've always said about the 504 program, it's kind of a program that really depends on economies of scale. Like you have to, it had the loan has to be of a certain size to make all the economics work with the fees that you're going to pay with, working with the CDC and the SBA and the bank and everybody involved. So it could take, it just takes a certain size transaction for 504s to work. But I think overall, this is a very good change. I think having this program and, being able to do this more flexibility on refinances and things, I think it's a good thing. So I just wanted to point that out to everyone. So let's see here. So that was the SBA thing. So let's go on to the next one here. So, okay. Millions of businesses have a new reporting deadline coming up with potential penalties. So this is all about beneficial ownership information. If you do not know what beneficial ownership information is, you need to absolutely go check that out. I did a whole episode on beneficial ownership information. So if you need more info there, check that out. There's a whole lawsuit that's going on right now with beneficial ownership information, and I was waiting. There should have been an update in September. We really didn't get much information. I'm hoping that there will be more updates there. So the National Small Business Association is the organization that brought that lawsuit, and so we were waiting for kind of an update there. And my opinion has been, I think people could basically hold off for a little while longer until they register, but it is something you need to be aware of. So, I think that if we get to, if we start getting to December 15th, December 20th, and nothing has happened and nothing has really looked like it's happened, probably at that point, it'd probably be a good idea to think about, going on and registering and getting it done. Now, my understanding so far is that it's not a hard thing. It's not hard to register. It's a pretty simple process. I am just vehemently opposed to this whole thing because I just think it's an invasion of privacy. And I think it's ridiculous in some ways. I think it's like a cash grab by the government just to get another, couple dollars out of your pocket. And I don't like the fact that there are a lot of government agencies that can get access to this information. Foreign governments can get access to this information. And I'm just not cool with that. I'm not down with that. I think that's nonsense that they're doing this, that they're creating this database and then allowing anybody to go, in there. I mean, this is why you have the Fourth Amendment. You have a right to privacy. You have a right. It's like, if the government is investigating you, there's a process for that. If the government thinks you're doing something wrong, they open up a case. They come in, they start asking questions. If they think that there's something fishy there, they then go to a judge and they get a warrant, and then they come in and they can search your place or search your business or whatever they want to do. They could call you in and basically say, hey, you got to come in and talk to us. You got to answer a bunch of questions, then if they think there's something there, they open up a full-blown investigation and they start, going at it. And then it's, grand jury time, and convene a grand jury and file charges against you. That's the process. But here, this almost feels like they're circumventing that. Like they wanted to get in and see what's going on. They don't have to do any of that. They don't have to officially open an investigation. They don't have to get a warrant. They have to do anything. They just go into the database and boom, get your info. I mean, and again, I don't know. I'm a little jaded with this. I think the Patriot Act kind of jaded me a little bit with a lot of this stuff, but it just feels this whole thing has felt to me from the very start as like government overreach. But anyway, the article goes in here and just talks about the Corporate Transparency Act, how that was passed, how you have to register. If you have an existing business, you have to register by January 5th, 2025. But there are penalties on this thing, and the penalties are, I think are ridiculous, But let's look at a couple things here. So basically it says, what does FinCEN and the Treasury Department want with the information? While detractors have said small businesses are largely unaware of the new requirement, most service providers will be. That means when small businesses use their lawyer, their accountant, or other service providers, they likely will be told or reminded of the requirement. Yeah, I think that's pretty true. But I also think that there's kind of a double-edged sword here. Like, the reason why there hasn't been a big promotion of this is because when people start looking at it and they start asking questions, they're going, yeah, this is a bridge too far. This is ridiculous. I don't want to do this. I don't want to comply with this. So this is why, FinCEN and the Treasury Department have been on the very, very, very down low with this. They've been basically like, okay, well, we'll just kind of, we'll gently put the word out there. I mean, look at the title of the article. Does it say beneficial ownership information? No, it just says millions of businesses have a new reporting deadline. That couldn't be more vague, so how's that grabbing anybody's attention? No, it's, so they're telling people without technically telling people, really getting the message out there. But anyway, again, I digress. But what was I looking here? Why does FinCEN and the Treasury want the department? They never really answer that question here. It's like, well, it's, this is to stop all kinds of illegal activity. We're trying to bust criminal networks and national security, and, we're going after terrorists and money laundering and everything. Like, okay, all right. I've heard that thing about 500 times. All right. But at the end of the day, I just wanted to make people aware of the whole beneficial ownership information thing. Go check it out. Like I said, I will be doing another episode on it, but I'm probably waiting until the end of October to do that, because I'm trying to wait to see if there's anything happening with this lawsuit before I do that update to the video. And when I do that update to the video, I'll go through the websites. I'll go through how to sign up, how to do everything. So we'll get into all that. Okay. All right. I thought this was cool. A cool article about ChatGPT. So ChatGPT was tested against 2,800 work skills, and here's how many it replaced. And so as we get down in here, so despite a veritable tsunami of hype around OpenAI's ChatGPT and other generative AI tools, the technology is unlikely to fully replace any work skills anytime soon. What? Wait, what? Hang on, what? After a thorough analysis, Indeed found the generative AI was particularly strong in theoretical knowledge, but less effective in problem solving and incredibly limited in solving issues that required, unsurprisingly, a physical presence. So generative AI is pretty decent. It's some of the theoretical skills and textbook knowledge, but when it comes to the rubber hitting the road and applying that knowledge, generative AI is lacking. Overall, the Indeed study found that 68.7% of skills were classified as very unlikely or unlikely to be replaced, while 28.5% could potentially be replaced by AI, and there were none that were very likely to be replaced by AI anytime soon. So, what we are seeing right now is that based on the current capabilities of generative AI, it is not there yet on skills, let alone jobs. And this person added that jobs are essentially a collection of skills. These technologies are more likely to enhance human productivity in the long run, thus creating more jobs for people. In accounting, for example, where 78% of the skills were created possible or likely to be replaced by AI. They basically stressed that filling out tax forms would simply free up the accountant to take on more complex tax work or take on more clients rather than replace them altogether. So I agree with that about the accounting field. I mean, if you're just doing a basic tax return, it's pretty easy to deal with that. I mean, you could feed the tax information into the computer, and you can kind of let the generative AI do its thing, and that would free an accountant up to work on more complex issues. Audits. Especially if they're working with businesses, it could be doing reviewed, compiled, audited financial statements, all kinds of stuff like that. But ultimately, generative AI is different than previous attempts at automation and robotics because it is not likely to replace in-person jobs or jobs with manual labor, but white-collar and so-called office jobs. So, and then the article goes on to say, but as the technology evolves, so might its capabilities. And while generative AI cannot currently completely replace any one skill, it might be able to do so in the future. Meanwhile, workers and managers alike should watch for how much in demand these AI skills are. While workers might not be replaced with AI, they might simply be replaced with another worker who happens to have AI skills. So according to job data tracked by Indeed, just 0.2% of job postings mention generative AI related terms. While that is up from essentially zero in 2022, it's still a remarkably small share. The fact that we are at zero right now says to me that we are at a place where generative AI can do some things pretty well, but when it comes to taking jobs, it's not something that's going to happen in the short time frame. So, of course, experts warn businesses should tread very carefully when mixing AI with human resources, but not just because of potential legal liability, but also because of morale issues. And then it wraps up by saying, while studies have shown some productivity benefits associates using AI, experts warn about potential litigation and an ongoing issue with hallucinations that sometimes lead a generative AI tool to giving incorrect answers. Meanwhile, some larger companies such as Samsung have prohibited their employees from using ChatGPT at work, part of an ongoing backlash to ChatGPT developer OpenAI and other AI tools and companies. Experts say companies need to proceed with caution when it comes to using AI to cut labor costs, as there are several important factors to consider that transcend the bottom line. So, so I thought this was a really cool, interesting article here on ChatGPT and basically how ChatGPT is not quite ready to take us over yet, not quite ready to replace all of the white collar jobs that take everything away from us. So I think that the real advantage to AI is going to be in enhancing people's ability to, in other words, making people more efficient, making people be able to do more things throughout your day. I think there's a lot of potential for that in the next 5 years. I think there's more so potential for that than necessarily AI just, taking all of our jobs or whatever. So, okay. One more article here before we jump into the business news. So this was kind of interesting. So business casual line is getting blurred as returns ramp up. So basically, as people are coming back to the office, this concept of casual and business casual is kind of causing some vexing of employees. And so this basically says here that the shifting dynamics of remote and in-person work are getting an extra layer of complication. What are employees supposed to wear when they show up for work? It's kind of surprising that people would have to ask that, but the concepts of casual and business casual are vexing employers and employees alike post-pandemic, even in offices where those dress codes are in place. A recent survey by the International Foundation of Employee Benefits Plans found that 54% of employers have a business casual dress code and 43% have a casual dress code. Which is again kind of interesting. So I have actually done a couple episodes on this. I did an episode called what is it? Does the suit? I did an episode called "Does the Suit Make the Man?" where I talked about I went over a couple articles that basically discuss like why do you dress, why particularly for guys, like why do guys dress a certain way, why do you wear suits, why should you wear suits, what type of suits, what are you looking to achieve, what do and it's all about what are you projecting, what are you projecting to other people, are you projecting confidence, are you projecting know-how, sufficiency, just trust, what is it that you're showing people, they're the old adage, you dress for the job that you want, not the job that you currently have. And I don't know, I personally feel like the whole casual dress thing has gone like, you had pendulums, right? So, on the one pendulum was when I started working in the financial services, 24 years ago. The pendulum was basically like, you got to dress to the nines every day. It was, suit and tie, full suit, cufflinks, the whole 9 yards. And if you didn't look right, they literally, you got sent home. Like if you showed up, you didn't have a tie on, you didn't have a sport, you didn't have your suit jacket. You just, if you look sloppy, if you just like didn't look right, I mean, they would straight up send you home. It was like, all right, you're gone, go home, clean yourself up and come back. And that, so you had the pendulum up there. Now I think the pendulum has swung way too far in the opposite direction. And we've gotten to this part where, there's so many companies, I hate to say it, that I walk into and just everybody looks like, slovenly. That's a nicer way to put it. And I think that, and I will say this, I do think that in a very real way, dressing business casual is more challenging than just dressing up. When you have to put a suit on, that's pretty straightforward, right? You go out, you got your suit, you got your pants and your coat, and you put a shirt and a tie on, you get your dress shoes, and boom, you're done. That's pretty straightforward. And then it's just a question of what kind of suit do you want to wear? What kind of shirt do you want to wear? That kind of thing. But, business casual is more like, okay, what kind of a pants am I wearing? What kind of shoes am I wearing? What kind of shirt am I wearing? Am I wearing more of a laxed button down shirt like what I'm wearing now? Or am I wearing a more formal white button down shirt? It's like, am I wearing a shirt with buttons up here? Am I wearing a shirt? So there's a lot more things to consider. What type of sport jacket am I wearing? Am I wearing a vest? Am I not wearing a vest? Is it too hot, too cold? Like what are, so there's a lot of different kind of factors you have to figure out there. What am I doing throughout the day? Do I have meetings? Do I have to go outside the office to represent the company in some fashion? Those kind of things. So again, I just thought this was kind of an interesting article, talking about how, as the remote work thing is beginning to come to an end and people are coming back to work, the kind of the confusion amongst, businesses not really, I think, wanting to be too hard on employees, and employees coming back basically like, well, okay, can I basically just look like I rolled out of bed and come in here, or do I need to put some kind of effort in the way that I look? And I don't know. Like I said, I find the whole thing fascinating, but I just think that, and I don't know. Maybe people could tell me. Maybe I could get something in the comments here. Like, I'd be really interested if people think, should businesses, demand more of their employees in terms of how they dress and how they carry themselves? I think there is a lot to be said for that. I think if you set a certain standard and you adhere to that standard, I think that's a good thing. I don't think that's necessarily a bad thing. And you kind of build that into your company culture. So, but anyway, okay. So that's what I got with that stuff. So before we get into this, so let's hop out of that for a second. Okay, so I want to start getting into some of the banking news here. I want to get into what are the economic indicators that are coming up next week. So Monday, October 7th, we have consumer credit. On Tuesday, October 8th, we've got the trade balance, and then we've got Atlanta, the Fed, the GDP now numbers for the third quarter will be coming out on Tuesday. On Thursday, October 10th, we get the continuing jobless claims, initial jobless claims, the core CPI, and then regular CPI. We get the federal budget balance for September. And then on Friday, October 11th, we've got the PPI, the month over month, and we've got the Michigan consumer sentiment and the U.S. Baker Hughes total rig count at 1 o'clock on Friday the 11th. So I think obviously Tuesday, the Fed GDP now numbers for the third quarter, a lot of people will be looking at that. On Thursday, the CPI data, and then some of the jobless numbers, and then obviously Friday with the PPI. So people will be looking at that inflation. They'll be looking at the jobs data. They'll be looking at the GDP numbers, and we'll take a look at all that stuff next week, and we'll see what ultimately comes out of that. So. Okay, if I can go into a couple of economic indicators for things that came out this week. So we had durable goods orders were flat in August. So the Commerce Department reported that new orders for manufactured durable goods were virtually unchanged in August. After increasing 9.9% in July, shipments of durable goods decreased by 0.5% in August. Service sector index increases in September. So economic activity in the services sector increased in September, the third straight month of growth, according to the Institute for Supply Management. So ISM's index registered 54.9% in September, the highest reading since February of 2023. And then we also had manufacturing contracts in September. So economic activity in the manufacturing sector contracted in September for the sixth consecutive month. According to the Institute for Supply Management's ISM Manufacturing Index registered a 47.2% in September, matching August reading. 47% is not good. Construction spending dropped in August. So construction spending fell 0.1% in August, but was up 4.1% from a year ago, the Commerce Department reported. Private construction was 0.2% below July, but public construction rose 0.3%. So there's some economic data information we had there. All right, so let's get into. I want to go into next here. So you know what? Let me touch on this real quick. So okay, there were more job openings in August, but hiring slowed. So hiring, quitting, and layoffs all slowed down in August as the job market became increasingly stagnant for workers and employers alike. High interest rates have hurt the job market, and officials at the Federal Reserve are slashing borrowing costs to prevent unemployment from spiking. The hiring slowdown highlighted how the job market had weakened since the post-pandemic recovery when workers were in high demand. So finding a job opening was easier in August, but getting hired got tougher amid a cooling labor market. There were 8 million job openings in August, up from 7.7 million in July, the Bureau of Labor Statistics said Tuesday, but it was the first increase in 3 months and was higher than the 7.7 million forecasters had expected, according to a survey of economists by Dow Jones Newswires. So a couple of things there with that. So job openings, they were as of a couple of years ago, they were as high as almost 12 million, and they've come down. Literally over 4 million job openings have gone away here as either people have filled jobs or companies have eliminated jobs, or whatever. But one of the episodes I did about a month or so ago was I talked about what's called ghost postings, and about how basically half of the job postings that are out there basically aren't real. Like, companies will put a post out there and basically just forget about it or ignore it, or they'll just continue to go through until they eventually feel like they found somebody a year or two later. So there's a real question there as to, okay, so there's 8 million job postings out there, but are they really looking to fill 8 million jobs, or is it maybe 4 million jobs? So there's just a couple things there for food for thought. Now, obviously, We got the job numbers today, which basically said that basically, like, I think 245,000 jobs were created. If you believe that, I've got some land in Florida I need you to buy real quick. So I need you to call me up as soon as this is over. Yeah, I could guarantee you, as the sun comes up tomorrow, that those numbers will be revised drastically downward starting next month. So I just think that jobs report today was just total nonsense. So okay, layoffs usually high for this time of year. New report shows, but should you worry? So companies laid off fewer workers than the month before, but the most of any September since the pandemic, according to a report by a consulting firm. Official government labor market measures paint a different picture of layoffs, stating near historic lows. The Federal Reserve is closely watching labor market data for any signs of weakness, and the Fed could cut interest rates faster to bolster the economy if layoffs rise. So the U.S. employers announced 72,800 job cuts in September, down. Consulting firm Challenger Gray at Christmas said Thursday that figure, not adjusted for seasonal patterns, was 3,000 fewer than in August, but was the most layoffs for any September since 2020. So just kind of, again, interesting information there. Obviously, this week we had the U.S. dock workers, the massive strike that was going on there for a little while, but that strike got postponed as of yesterday. They're going to try to negotiate out a deal there, which I think is kudos to them, hopefully, for finally getting that thing finished and done. Well, it's not finished and done. They basically postponed it till January to hopefully be able to work out a deal over the next couple of months. We're basically work out a deal over the holidays to get something completed there. But hopefully that happens, because, I don't want to see all the Costco's and everything basically running out of, toilet paper and paper towels and everything else. So, okay. Here was an interesting article. What McNuggets tell the Fed about inflation? So, some key takeaways on this. So the popularity of value meals at fast food restaurants points to a major reason that inflation has fallen in recent months. Customers have responded to higher prices by seeking cheaper alternatives for their purchases, which in turn pressures merchants to offer deals and keep prices low. The trend at McDonald's illustrates the old economics adage that the solution to high prices is high prices, a Fed official said in a speech Wednesday. So if you want to understand why prices for many things aren't rising as fast as they were a couple years ago, a good place to start would be the drive-through. That's according to one of the officials at the Federal Reserve, who sets the nation's monetary policy to keep inflation under control. In a speech Wednesday, Tom Barkin, president of the Federal Reserve Bank of Richmond, said the habits of McDonald's customers showed why inflation continues to fall. Customers are driving this drop, Barkin said in remarks at an economic conference. Frustrated by high prices, they have become increasingly price conscious. The annual inflation rate went down. Yeah, we all know that. They're still spending, but they're choosing. Trading down from beef to chicken, from sit-down restaurants to fast casual, from brand names to private labels. They're waiting for promotions, opting for the $5 value meal at McDonald's, or jumping at discounts on Target. So while that is true, and again, I'm going to get to why I'm pointing this out in a second here. So while that is true, that's already been happening. We're already well aware of that. People have already been doing that for 2 years now. As things get more expensive, they look for the cheaper alternatives. I always like to look at fast food because it is a fantastic barometer of where things are at with the economy. It's just like looking at, if you want to know how. Like a great barometer for how the real estate market is doing is look at Home Depot and Lowe's. If Home Depot and Lowe's, if their sales are booming, that usually tells you there's a lot of renovations going on. People are sprucing their houses up to get them sold. So if Home Depot and Lowe's are selling great, that usually means the real estate market's doing pretty good. It's not and again, these things aren't like hard and fast rules, but they're just great things to look at. It's like, it's not always, causation doesn't always equal correlation, that kind of thing. But they're always great things to look at. And like I said, fast food to me has always been a great barometer of where the overall economy is at. So if people aren't buying fast food, if they're complaining they can't afford fast food, Houston, we have a problem. That's usually about the point where people start getting really upset, because it's amazing when you look at fast food numbers, because a huge amount of families in this country basically live and survive off of nothing but fast food. And it's some people might find that hard to believe, but it is actually is true. So when the price of fast food goes up, these people can't afford fast food, and now it's like, okay, well, what are we eating? How many other cheaper alternatives are there outside of fast food? There's some certainly, but not a whole lot. But anyway, my point there being is that, like, when people start grumbling about the price of fast food, about how they can't afford anything, that's usually when you start to see, that's usually when politicians start getting real nervous, because that's usually about the time you start seeing some political change. You start seeing some people getting voted out of office. So like I said, I always just like to keep an eye on fast food, just like I like to keep an eye on Home Depot and Lowe's, because they, like I said, these kind of trends, these kind of things they're a little quirky. But there's kind of, like I said, there's a little bit of method to the madness. So, so you just kind of keep an eye on some of that. So, okay. Let's get into some banking news real quick. I'm gonna run through. So for the rest of the time here, I'm gonna run through some banking news. I got a couple of things I want to cover. I got some Federal Reserve news I want to cover, and then I'm gonna run through some articles and then show you guys some charts and graphs toward the end. So just hang in there. I've got a lot of continuing good stuff to come here for the rest of our time together tonight. So, okay. So Bank of America Corp customers reported trouble assessing their accounts on October 2nd, with some people seeing zero balances in their accounts. CNN reported, citing data from Down Detector, which showed a spike in such reports around 12:45 p.m. The bank said the issues are being addressed and have been largely resolved, according to the report, citing a statement by the company. Bank of America, however, did decline to specify the cause of the problem, the report said. So yes, I was kind of monitoring this, because I was wondering if this was going to turn into a huge story, but it just, kind of blew out as soon as it came in. But yes, there were a lot of people this week that logged into their Bank of America account and saw zero balances. And I'm sure a lot of people were freaked out when they saw that. And but like I said, Bank of America was able to get the problem resolved pretty quickly, within basically 24 hours. And but when asked what the problem was, like whether was this a cyber attack, was something else going on, was it's an internal issue, we don't know. But like I said, it was an interesting story for the week. So. Dallas-based First Foundation, along with its subsidiary First Foundation Advisors and First Foundation Bank, announced the reclassification of $1.9 billion of its multifamily portfolio from loans held to maturity to loans held for sale to strengthen the company's balance sheet and improve flexibility. The company expected third quarter fair end value pricing to exceed 92% of the $1.9 billion principal balance, and the resulting write-down to fair value to impact third quarter earnings and reduce its tangible book value per share. So I like this one. I wanted to point it out because, again, this is the kind of thing that you are seeing a number of banks out there doing right now. So it's just kind of an important trend in the business to kind of keep an eye on. Berkshire Hathaway further sold Bank of America stock this week, reaping $338 million, according to a regulatory filing. The sales of the bank stock have continued to decline for the third consecutive round, achieving some of the lowest prices since the company started liquidating shares in mid-July. So for anybody who doesn't know, I've been kind of following this. So Berkshire Hathaway, Warren Buffett has been building this massive war chest. He's been selling a ton of stock over the last couple of months. I think he's sitting on $300 billion in cash right now. So you have to ask the question, like, Warren's a pretty smart guy, pretty savvy investor, has made himself one of the richest men in the world, and he has a pretty amazing track record of kind of investment successes. So yeah, I think you have to always take a look at what Warren is doing, and you have to ask yourself, like, why is he selling out now and building this massive war chest? And you also have to understand too that Warren is what's called a value investor, meaning that he's looking at the underlying value of a company. He's not without getting into too much detail, I'll put it like this: you have fundamental investors and you have technical investors. Technical investors are looking at trends, they're looking at stock charts. fundamental investors are looking at the financials of the business, the underlying financials. What do they tell you? That's really more Warren is. Warren is very old school. He's a fundamental investor. He's going to look at those, what's going on with the company there, and what fundamental investors, value investors, what they want to do is they want to buy on the cheap. They want to buy low and they want to sell high. And that is what Warren has always done. So he's building up that cash because he thinks something is coming where he's going to have a once in a lifetime buying opportunity, and he's going to be able to buy stuff at rock bottom prices, and he's going to be able to buy a lot of it. And that's why that could be why he's doing what he's doing. So just something to point out for food for thought. So, okay, the U.S. SEC is appealing a federal court's ruling in its enforcement case against Ripple Labs, arguing that the verdict contradicts established Supreme Court precedent and could impact the broader cryptocurrency market. The Wall Street Journal reported, citing a notice of appeal filed October 2nd. So the U.S. Court of Appeals for the second quarter will review the lower court's decision, which stated that Ripple's sales of the XRP cryptocurrency token on exchanges did not require compliance with investor protection laws, the report said. A subcommittee of the Commodity Futures Trading Commission's Global Markets Advisory Committee has voted to advance recommendations for registered firms' use of blockchain technology and holding and transferring non-cash collateral, setting the stage for a full committee vote later this year, Bloomberg News reported, citing two people familiar with the matter. So, as we continue to see, stock exchanges, central banks, the Commodity Futures Trading Commission all keep continuing to dabble in blockchain technology, in tokenization, in digital assets. So they're, I think the momentum for a central bank digital currency or something along those lines is certainly there, and it's certainly something that we all have to keep in mind because everybody doesn't want it, but everybody certainly seems to be working on it. So. Fed Governor Michelle Bowman aims to strengthen coordination with state banking regulators to ensure consistent and effective supervision of financial institutions, particularly smaller banks, according to prepared remarks delivered October 2nd. The top official also urged banking agencies to rethink their approach to determining levels of regulatory oversight based on banks' asset thresholds, arguing that it should be the bank's business models that deserve attention. Almost all U.S. banks emphasize in-person and high-touch practices for their small business customers, preferring the use of technology for regulatory compliance, data management, and servicing small business loans after loan approval, according to a study by the Federal Deposit Insurance Corp. The report also highlighted the increasing competition of banks with credit unions and non-bank financial technology companies, the ongoing consolidation within the banking industry, and especially between community banks themselves, further speaks to the pressures of being a small institution in the current environment. The pandemic and subsequent rise in interest rates tested the U.S. banking industry. So hang on, guys. I need a drink here before we keep rolling here. All right, let's see. What else do I got here? The FDIC granted conditional approval to Five Rivers Bank, a proposed state non-member bank based in Paramus, New Jersey. The bank aims to offer traditional banking services to small and medium-sized businesses as well as individuals in the state's Bergen County. I just thought that was kind of interesting. I think probably more to follow there in the coming months. But it's just something I thought was interesting. We'll keep an eye on that. Wells Fargo and Company is not likely to get rid of its Federal Reserve ordered asset cap anytime soon, Compass Point analysts said. A new written agreement with the Office of the Comptroller of the Currency includes requirements that indicate Wells Fargo remains out of compliance with the Fed's 2018 cease and desist order, which necessitated its asset cap. So, yeah, not looking like the Wells Fargo is going to get out of that, at least, in the not too distant future. Senator Elizabeth Warren wrote to acting controller of basically the head of the SEC, Michael Hugh, arguing stronger regulation of Citigroup, such as growth restrictions, as the bank has become too big to manage, despite a number of blunders in recent years, including erroneously wiring $900 million to a client company's lenders. That was good. That was a good story. I remember when that happened. But I don't necessarily agree with Miss Warren. I put it gently on a lot of things, but she, a as they say, a broken clock is correct twice a day. Um, I don't necessarily disagree with her sentiment on this one. I've kind of said that when you look at the big four banks, I kind of feel like the only bank that has really proven that they run well and efficiently is, to me, is JP Morgan. Bank of America probably comes in second there, but I think Bank of America has some issues under the hood. They just do a very good job of kind of keeping it quiet. Wells Fargo, Citibank, the two problem childs. They just constantly in the news, constantly have problems, constantly getting fined for this and that. Although TD Bank is giving them a little bit of a run for their money more recently, but I've often said, like when the whole scandal with Wells Fargo broke, I said that the bank should be. I have always felt that bank should be broken up. I felt like they had gotten a rotten culture, and that there was just too many problems, and that somebody coming in was just not going to be able to fully ever really correct what was going on there, just because of the size of the bank, all the things going on there. I felt it would have probably been better if they had broken, Wells Fargo up into maybe 7 or 8, larger regional banks. But who am I? I'm just some nutty guy with a podcast on YouTube on Friday nights. um, um, all right, let's see here. U.S. trading platform Robinhood Markets is set to launch margin trading in the U.K. in the next 2 weeks, allowing individual investors to make leveraged stock bets on its platform, the Financial Times reported, citing an interview with Robinhood co-founder and CEO Vlad Tenev. The move comes ahead of Robinhood's launch of long-term savings products in the U.K. as it aims to become a mainstream investment platform for younger investors, the report said. I also have that Robinhood Markets Inc. unit, Robinhood Crypto, has launched cryptocurrency transfers for its European-based customers. So Robinhood seems to be moving full speed ahead over in Europe, where I guess that maybe it's a little bit easier for them to get some things done right now. I don't know. I'm not a Robinhood fan. I haven't been a Robinhood fan. I think they've done a lot of shady things over the years. I think they have shafted their customers in a number of ways. But they continue to just rolling out the products here. So let's see here. What else do I got here? I want to hit some other stuff here. Maybe I'll go in as if this. I'll hit this last thing here, and I'll move on to some other stuff here. So, the Toronto TD Bank basically is in talks with U.S. federal prosecutors over a potential guilty plea related to criminal charges that the Canadian bank's U.S. retail bank failed to avert money laundering tied to Chinese crime groups and illicit fentanyl sales. The Wall Street Journal reported, citing people familiar with the matter, the plea could come in the next 2 weeks, according to the report. The U.S. Justice Department earlier this year launched a probe into the bank's internal controls after agents discovered a criminal Chinese operation had laundered hundreds of millions of dollars from illicit narcotics in New York and New Jersey through TD and other banks. TD Bank said it has been working to address the issues raised and has allotted more than $3 billion to settle the probe. Interesting stuff there. So, okay. I want to get into a couple of Fed articles here, but I'll kind of hit these as I go through these other articles. So let's jump into a couple of things. Let me just find what I'm looking for here first. Fed rate cuts. That was one of the ones I'm looking for here. All right, let's start. Let's jump in with this one. So ConnectOne, up in New York. So ConnectOne is in a unique position while preparing to cross the $10 billion threshold. So I just thought this was kind of interesting to note. So crossing the $10 billion threshold can be costly for banks, but ConnectOne Bancorp is in the position to make the leap with little effect on its revenue. When surpassing $10 billion in total assets, banks can be subjected to further oversight by the Consumer Financial Protection Bureau, alongside additional rules, including the Durbin Amendment, which caps debit interchange fee revenue. ConnectOne, which had $9.72 billion in assets as of June 30th, recently announced an acquisition of First of Long Island Corp., expected to push the combined company to $14 billion once the deal closes. However, the commercial bank relies so little on debit interchange fees banks collect from merchants when customers swipe their cards, that crossing the 10 billion asset threshold is of almost no consequence to the bank. Chairman, President, and CEO Frank Sorrentino III said in ConnectOne's second quarter earnings call in 2022. This is one of the easiest crossings I've ever seen. Stevens Inc., who's analyst Matthew Bree said, I would put ConnectOne in maybe a unique category of banks crossing 10 billion. I don't know if there's really any impact from a revenue perspective. So, and then they kind of they have a chart here, basically U.S. banks crossing the 10 billion, 20 billion, 50 billion, and 500 billion total assets threshold. So those are basically the key marks. And I would also add 1 billion in there too. So like when you cross a billion, you have all different factors and different things you got to look at. But then when you cross 10 billion, when you cross 20 billion, when you cross 50 billion, and then finally when you cross 500 billion. So I just thought this was it's just an interesting case study that was going on here. So, because like I said, they are doing what I think a lot of banks out there would do. Like, in other words, they're taking, they're about 10 billion in assets, but you can't just cross, you can't go 10 billion in $1. You really got to try to get to 11, 12, 13 billion as quick as you can. Now they're doing it just with a simple acquisition. Buy the one acquisition up, they'll be $14 billion. So that's perfect. Puts them right kind of in the sweet spot that they need to be coming out of that. And so that's good. So that's just, again, something I thought there. BSA AML focus boosts number of severe enforcement actions issued to banks. The whole TD Bank fiasco I just mentioned. So a number of severe enforcement actions handed out by regulators has increased for the second straight year, and many are related to U.S. banks' compliance with the Bank Secrecy Act and anti-money laundering rules. As of September 19th, U.S. bank regulators have issued 48 severe enforcement actions so far in 2024, already surpassing the 43 such actions issued in full year 2023. So banks defending against large increases in fraud and other criminal activity are more likely to experience lapses in performance that are criticized by regulators and lead to supervisory and enforcement actions. Some of the banks that were hit by severe enforcement actions related to the BSA and AML rules have fintech partners or a significant digital strategy. Now, why is that important? If everybody remembers the episode that I did on Synapse Financial, which failed and filed for bankruptcy, huge mess, involved a number of banks across the country. They're still trying to untangle it, and there's $85 million missing right now. You got the Synapse people pointing the fingers at the banks pointing the fingers back at the Synapse people. But it has brought this entire notion of kind of the relationship with your fintech vendors, fintech partners, and how do you manage that relationship? What should banks be doing? What should fintechs be doing? And but it's really brought to the forefront. A lot of regulators now looking at the BSA and the AML to basically understand, like, okay, what's going on here with your bank? And obviously, all the issues at TD Bank has also brought this further under the microscope. So just like I said, it's a good trend to keep an eye on. Like, what's going on? This tells you that the regulators, that this is a big issue for them, and they are really they're really taking a look hard at this particular issue. So okay. Hang on. This is what I was looking for here. Okay, so bank-owned e-commerce wallet Pays launches on 120 million cards. Now, crazy enough, the highest view episode I have done as of yet in my little over a year being on YouTube here and doing this podcast, I did an episode on the Pays digital wallet, and it got a huge number of views. I didn't think that was one of the better episodes, or even a more interesting episode, but for some reason people loved it. So I saw this and I wanted to do an update on it. So the Pays, a digital wallet operated and owned by banks, is available for consumers of 120 million credit and debit cards in the U.S. to pay for orders on e-commerce websites. Those cards are issued by the owners of Pays' operator, which is called Early Warning Services, LLC. Early Warning Services also owns the Zelle payment platform, which they then, basically contract with other banks around the country to use. So if anybody uses the Zelle, payment platform, this is the same company has now created this Pays digital wallet. It is a consortium owned by Bank of America, Capital One, JP Morgan, PNC Financial, Truist, US Bancorp, and Wells Fargo. Pays also has access to cards issued by credit unions through US Bancorp subsidiary, Ellen Financial Services. The banks have uploaded the Pays to Pays the cardholders' information, including card number, email addresses, mobile numbers, and billing addresses. Users can now activate Pays through their mobile banking apps with a few clicks without needing to type in that information manually. For those cardholders, Pays will show up as one of the payment methods when they check out at participating online retailers, alongside other options offered by such non-banks as PayPal or Apple. Pays will be focusing on raising consumer awareness in the coming months, said Catherine Murchie, head of operations of Pays, who joined Early Warning Services in June. Pays aims to include more financial institutions over the next year, in addition to 7 bank owners of Early Warning Services. What made us drive to create the solution was the importance of having a bank-backed solution, so a solution that consumers could use that was backed by the trust of their financial institutions. Now, here's a thought. So it's a digital wallet. What else? If I had to think, what else could you do with a digital wallet? If I was going to buy Bitcoin, what do I need to own Bitcoin or Ethereum or Doge or any other cryptocurrency? Oh, that's right. I need a digital wallet. That's interesting. So is it a leap to say that they are rolling this out because they're looking down the road and saying, you know what, if there is a digital currency, remember, one of the big owners here is JP Morgan. JP Morgan has already created their own digital cryptocurrency called JP Coin. So they've already got their own digital currency. It's just all they have to do is get people to use the digital wallet here, the Pays digital wallet. You use Zelle. We get you the JP Coin, get you some other cryptocurrencies, and all you got to do is turn a button and boom, you're up and rolling. So just something to keep a thought on there. So okay, all right. What else do I have here? I guess I'll run through. You know what? Let's just run through. I'll just run through some headlines here on some of these things real quick. So, U.S. housing market stalls ahead of Fed rate cuts. So, so housing market still not doing so great. U.S. banking industry valuation falls below 150% of adjusted tangible book value in September. Why total CRE, commercial real estate at U.S. banks, might sometimes include owner-occupied properties. CRE trends here. Let's see, I could go more into that. Fed rate cut opens the door to further global central bank easing. So for people who don't know, I mean, basically central banks around the world have been easing their rates for a number of months now, well before the Federal Reserve ever did anything. It's been one of the most, from a global perspective, has been one of the most aggressive rate easing time periods that we've seen in recent history. And now, like I said, the Fed decided to join the party. And so you can kind of see here from this chart, you got Australia, Canada, the Eurozone, India, UK, US, and you can see basically everybody's been cutting rates here for basically for the better part of the last year. A lot of central banks around the world have been cutting rates and have been going down. And let's see here. What else here? Wells Fargo unlikely to shake asset cap. Yeah, we talked about that a little bit earlier. U.S. hiring quitting slow as companies wait for lower rates. Yeah, we kind of talked about that a little bit earlier too. Vanilla deals point to a late 2024 bank M&A improvement. So bank M&A is warming up after a deal-making drought in 2023. And while transaction rates remain below average, advisors expect an improvement in activity in the coming months. So, we'll see. We'll see. There's still this very big election that's going to happen. So, okay. This is actually from the Wall Street Journal. So more banks call back CDs with higher rates. So the era of 5% cash returns is ending early for some investors. So before the Federal Reserve began cutting rates in September, banks offered certificates of deposit promising high yields for locking up cash years into the future. The highest yielding ones, with returns in excess of 5%, had features allowing the bank to call them before they mature, handing back the cash and accrued interest. Those features got little attention when rates were rising because banks weren't about to call their CDs and borrow money at even higher rates. And now, however, banks, including JP Morgan Chase and U.S. banks, are calling back more high-yielding CDs before they mature to save on interest as rates begin to fall. So, in the rush to lock in easy returns, many everyday investors likely purchased callable CDs without understanding what they were signing up for. A lot of investors will look at just the yield. We get people all the time who are like, wait a minute, my CD was called. Like what happened? So again, just something interesting, something to be aware of if you had any called CDs or anything out there. So, U.S. bank stocks post slight decline heading into Q4. Okay, that's all right. All right, so let's take a look at maybe a couple charts and graphs here. So this is interesting. So this is on reverse repos. Kind of an interesting topic of mine. So the reverse repo is declining quite rapidly and has fallen from basically 2.5 trillion to under 400 billion in just 21 months. Once this is drained, liquidity could start getting tight. Yes, you could say that. So if anybody has not seen my Lords of Easy Money series, I highly, highly recommend that you go watch that because there is a whole chapter to that book dedicated on the kind of repo crisis that occurred with the Fed toward the end of 2019. And some would say, and even suggest this in the book, that the only reason that crisis was averted was because we ended up having the pandemic, 3 months later. Not even quite 3 months later, probably about 2.5 months later. But the interesting thing that came out of that little mini hiccup crisis, whatever you want to call it, back in late 2019, was that the Fed was wondering, what does the repo market have to drop to before we start having issues in the market? And we did get an answer. It dropped to about roughly about $1.2 trillion was the number. Now you could see here, we have fallen way below that. We're down to 400 billion. And yet, things are still okay at the moment. We're not seeing any traumatic turmoil. So, I'm just continuing to keep an eye on this because I think it's something everybody should be looking at and should be basically saying it's like the yield curve. Everybody should be taking, I keep a look at the yield curve. I keep a look at the repo market, and I constantly keep an eye on these things because these are usually good predictors of what is about to transpire. So, an unusually large number of U.S. consumers are behind on their bills. 17% of U.S. consumers had unpaid bills at some point in 2023, according to the latest annual Fed survey. So a whopping 36% of lower income households with annual family income less than $25,000 did not pay all of their bills. So nearly 27% of consumers who rent their homes were unable to pay their bills in full. Notably, 11% of them did not pay water, gas, or electric bills, the most among all categories. And then it asks the question, how is this a soft landing? So Let's continue down here. Yep, world debt has now crossed $300 trillion and still continues to climb rapidly. So just look at that from 1997. I mean that's that's a pretty remarkable chart right there. That's pretty wild. This was kind of fun. This guy suggested basically the NSA was responsible for creating Bitcoin. If you've ever watched any of my crypto series, I did the first couple parts on that as a whole history on the founding of Bitcoin and even before the founding of Bitcoin. And I kind of talk about this a little bit. And one of the things I ask in that series is I kind of said, well, the dark web, the internet as we know it was effectively created by the government in conjunction with a bunch of academics, but the government had their hand in the creating of the internet. The government, specifically DARPA, created the dark web. So would it be that much of a stretch that they would have NSA would have maybe had some kind of hand in the creation of digital cryptocurrency? I don't know. But I thought it was interesting. So, okay. U.S. public debt has now jumped 345 billion over the last 3 days, hitting another record of 35.7 trillion. So since June of 2023, federal debt has surged by a massive $4 trillion or 14%. Over the same period, the U.S. GDP is up just 1.5 trillion or 6%. Again, another staggering chart to look at there. Just amazing. U.S. total debt explodes here, and just another chart there. And SOFR, single overnight financing rate, is still spiking, now over 5%. Now, this was October 2nd, so it was a couple days ago. But even as volume comes down from record high, almost half of the 50-point racist cut is unwound in 2 days. Makes you wonder if the jumbo size cut was because the Fed knew something was about to break. Interesting. All right. And okay, I'm going to end up with this. I got about 5 minutes left here. I just wanted to talk about some of the episodes, a couple of the episodes that came out last week and what is coming up this week. So last week, some of the episodes that were out, if you didn't get a chance to check out, I had that, like I said, I had mentioned earlier, the SBA interview with Paul Avery. I did an SBA update. I did an episode on how did Fannie Mae and Freddie Mac end up in conservatorship. Kind of an interesting little walk down memory lane on that one. Let's talk about, I did an episode on buy now, pay later products. I looked at U.S. banks looking to lower CD rates now that the Fed has gone into an interest rate reduction cycle. Banks are going to look to bring down the rates that they're paying on depository products, especially CDs. I did a review of Bank Director's 2024 technology survey, always one of my favorite surveys that come out, just looking at all different aspects of technology, whether it would be software or cybersecurity, hardware, different things that banks are doing, how much money they're spending on their IT budgets, things of that nature. So a lot of really good information in there. I did an interview with Ryan Stillwell, who is a commercial insurance agent, also owns his own business. I thought a lot of people there, we kind of focused in on commercial real estate, insuring commercial properties. So I think there's a lot of good information there for people if you haven't checked out that interview yet. Then I did, let's talk about deposit strategy. What are some things that banks should be doing, focusing on deposit wise right now in this environment where you're going to be bringing rates down, but you still need to grow your deposit base. You've got to have deposits are the lifeblood of every bank, and you got to grow your deposits as your funding source for funding loan growth. Okay, I did an episode just yesterday. I did the second quarter GDP number was what? I kind of go on a little bit of a tirade in that episode about what I feel is manipulation of the overall GDP number. This weekend, I did kind of a special episode yesterday called What is Up with Men Not in the Workforce? Again, kind of went on a little bit of a tirade in that episode with some things that I think issues that are going on in terms of how men may be treated in certain fashions today, and some of the issues with college universities. But again, I think people will find that episode very interesting. And then I did a couple episodes that related around crisis management. So I did learning agility and navigating a crisis. So the concept of learning agility and how Washington Alliance Bancorp, basically out in Arizona, how they navigated the bank crisis from last year. I thought it was a really interesting topic, and I kind of bookend that with an interview that will be coming out on Monday with crisis management expert Stephanie Craig. So if anybody would like to learn a little bit about crisis management in banking, when banks do strategic planning, they have to have a couple of things. They got to have what's called a business continuity plan, and they have to have what's called a disaster recovery plan. The difference being business continuity, if somebody dies, if something, your CEO gets hit by a bus, whatever, like what happens? Who takes over? How do you handle it? That crisis in the short term. It could also be a reputational thing. Maybe you guys get hit with a ransomware attack. Screws up your systems for a month, and you got all kinds of problems. And how do you navigate all that? Disaster recovery is, what happens if your headquarters burns down? What happens if you get hit with a flood? What happens if you have a major power outage? Like, how do you handle that? So I touch on a lot of that with Stephanie Craig. We kind of talk about different aspects of crisis management, preparedness, that kind of thing. So again, could be pretty interesting. Then I did another interview with a CEO named Patrick Wood, who owns a company called DelphX Capital Markets. And he had a very, very fascinating new product that the company rolled out called Credit Rating Securities, which was basically, so if an insurance company buys a bond and they want to protect against a downgrade on that bond, they would use this product, the credit rating security product, to basically shield them from downgrade on bonds. I just, being the kind of financial services, nerd that I am, I thought it was incredibly fascinating. I hadn't really ever heard of anybody doing anything like this. So, and Patrick himself is a fascinating guy with a pretty amazing background. And he's been in financial services for 25 years, has done investment banking, has done, different things within the banking sphere. So he's a very interesting guy. Check that interview out when it comes out on Tuesday. And then I did an episode called Let's Talk About Treasury Services. So I did the deposit strategy, but now I wanted to cover treasury services, which could also be considered cash management. So basically covered a whole bunch of different cash management services and how that all works into deposit strategy at the end of the day. So I think there's some really good information in that one. And then finally, I did, there's an episode that'll be coming out on Thursday called Review of FDIC 2024 Small Business Lending Survey that had some really good information about, how small banks versus big banks and fintechs, how they do underwriting, the type of data, soft data, hard data, different things that go into the underwriting process and different advantages. So some really interesting information that came out in that survey, and some really great things that I hadn't really gotten a chance to talk about yet that I got a chance to talk about in that episode. So keep an eye out for that as well. Next week, I'm actually doing a charity golf outing next Friday, which I actually was not thinking when I planned it, but it's a charity golf outing for cancer survivors that I do every single year. And, kind of an important thing for me. So I unfortunately will be tied up with that till probably at least about 8:00 next Friday night. So I won't be here to do the live stream. So I'll probably do the live stream next week on Saturday night. I'll probably do Saturday night at 7:00 next week. So there still will be a live stream. Like I said, it'll just be Saturday instead of Friday. I'll send out that notice to everybody so that you have it. And I think that's about it right now for tonight. So just, so a lot of I think a lot of good episodes, a number of interviews, different things coming out this week coming up. So I hope I'm putting out a lot of really good content for everybody out there to enjoy, and keep working on a lot of things. Like I said, got a number of things in the fire right now, as it were. A lot of people have reached out recently in contact. So I've got a lot of interesting different interviews and stuff coming up in the not too distant future, working on some different series like I had announced a couple weeks ago. Hopefully the kind of financial history series will be hopefully coming out here in the next month or two. I'll be rolling that out, so that should be a pretty fun and interesting series that gets rolling. But like I said, with that, I'm going to kind of wrap up. I hope everybody enjoys the rest of the night. I hope everybody has a great weekend. I got my Phillies kicking off the playoff here. I'm really keeping my fingers crossed that this is their year. Hopefully I don't have any Met fans out there talking too much trash. But go Phils, Red October. So I'm pretty excited for that. So, but I hope, like I said, I hope everybody has a wonderful weekend. I will see everybody again next week. Like I said, probably Saturday night. See you then. But enjoy the weekend. Have a great week out there. Talk to you soon.